Welcome to the Jay Martin Show. My name is Jay Martin, and my guest today is Henrik Zeberg. He's the founder of the Zeberg Report, a macroeconomist. And today I got into his thoughts on the equities market. He's expecting a blow-off top through 2023, leading into the real recession. I wanted to get his thoughts on how he's playing this, where he's allocating capital, whether in the gold space, in the equity space, in the crypto market, in the bond market. We covered all those buckets, and interesting to get his thoughts and his thesis on the inflation versus deflation debate as well. As always, beneath this piece of content, there is a link where you can subscribe to my weekly newsletter. I absolutely love writing it, and I would love to have you join the team. I publish every Sunday, and it's free and it's super fun. Here is Henrik Zeberg. Enjoy.
This is Jay Martin.
All right, here we are with Henrik Zeberg. Henrik, thanks so much for joining me on the show today. I appreciate your time.
Thank you for having me on.
Well, let's start here. I think in February, you were making some calls about the gold market, calling for a correction, possible gold pullback to $1,200. And we've since seen gold rally a little bit. So my question for you is that claim still valid? And if so, could you expand on it for me? And then second part of the question, what's causing the gold rally right now from your perspective?
Okay. Yes, it's absolutely still on that call. I mean, I know that people would like to see gold just move much higher from here, and every time we see some kind of easing from the Fed, and now the Fed hasn't pivoted yet, but will probably soon pause, I guess. Well, that's my outlook anyway. And then people say, well, now it's the time for gold to rally, and we just heard it over and over, haven't we? Since for us, for 10 years or so, but it just hasn't passed, really gotten by past that level that it reached in 2011, and I don't think we're going to go this time either. I mean, in terms of the way I perceive markets and the way I look at structures, we have a strong decline in coming in gold. I've said that for a long time, and I have to say I'm impressed by how it's been keeping up, but with a deflationary bust coming, which will be coming later this year, as I see it, then gold will not do well, and and there are some Fibonacci extensions that I use that tells me we're going a lot lower.
Can you walk me through that and what you're seeing that's going to apply that pressure to the gold price?
Yeah, sure. So obviously when we really get as a recession, the last time we had a recession, when we went into 2008, you saw gold hitting or actually starting to decline. And it declined by was it 34 or some percent from March of 2008 into September of 2008. And it did so because when the shit really hits the fan and when recession sets in, that's when you start to get the deflationary bust. That's when liquidity becomes a problem. And the finest job for gold is to provide liquidity when none can be found. Yeah. So that's why the finest value of gold is really to be there for you when you need liquidity. But the only way you can do that is by selling it off. So that's why I am one of the greatest gold bucks out here, and we have the gold miners report also, but I'm just saying, there is it's not an insurance you're buying, because we know we're getting into a bad situation for gold when liquidity is running out of the market again. But we have to just now, we need to stay a little careful around the timing of all of this and the sequencing of all of this, because right now we have now a market that will move into a phase, I call it Goldilocks phase on Twitter, which is a period or phase where inflation is not running too high. We still have an economy that is not in a recession, and that means that you will have a risk-on rally like nothing we have seen for a long time. We have seen that in Europe also already, starting to see stocks running really well, indices running higher there. And we also starting to see some of that coming into NASDAQ and also S&P of more recently. So I think it's going to run much higher there. And if you are seeing that, and if you're going to see also crypto, which you see Bitcoin has been moving up quite significantly over the last couple of months here, you don't want to be sitting with gold. Why would you want to hold gold there? So the first reason why I don't think we're going through to the moon here with gold is because you'd rather be somewhere else. You don't want to, pick up the dimes if you can pick up the dollars by being, long cryptos or something like that. But the recession is going to set in later in 23. And that's when we're going to have a replay of what we saw in 2008, where for a certain amount of time, gold will provide the liquidity that is needed in the market when when people are running away from assets and everything else. So So I think something nasty is coming, and in terms of the recession, and there are plenty of signals on that, and that will not be good for gold initially. And what I'm talking about here is a 40% drop or something like 50% drop. What I'm looking at after that is, gold running up 5 times what it's going to reach to, the lows that it's going to reach to. So I am a gold bull, and not a gold bug. I will not call myself that, but a gold bull. But it just in the short time frame, I'm not, and I think we're going to see that crash before we actually get to something which could be a very, very interesting entry point.
So between now and then, just to make sure I understand your thesis correctly,
Sure.
You're expecting a rally, quite an aggressive rally in the equities market,
right?
Somewhat false, somewhat of a blow off top, leading into the true recession, which hasn't really hit yet, into the end of 2023. That creates the liquidity crunch. We need to sell everything that's not nailed down, including gold holdings. You liquidate your gold to get some extra cash. That's going to depress the price, right? And then coming out of this, how am I doing here?
You're doing well. Keep on going.
Okay. And leading us into the true recession, which is where investors begin to look for safe haven assets, stability in those darker periods, in those harder times. And this will bring the capital back to the gold sector through maybe 2024,
this will be where the Fed will step back in for real, because they haven't stepped in back in for real. And when I'm talking for real, we are talking about the new genius solution of some kind. I mean, and trying to put liquidity into the market. So what we're talking about here is the moment when the Fed says, okay, now we are all in again. When they look the deflation in the eyes, and I've said for a long time we'll have deflation, even though 5-6 months ago it was laughed at. Now we see that the numbers are now down to 5%, and it's not so inconceivable anymore. And actually, we see a lot of things are actually coming down rather quickly. We've seen natural gas, we've seen lumber, we've seen the likes. So we are actually still in a deflationary phase, a long-term secular phase, or where the prices have been being squeezed because of the debt levels in the world. And this has not been solved yet. And that's why we still have one more big recession here. We actually have one major recession that's going to go through that before we get to the from a technical perspective, that's what I'm looking at, a structural perspective, to the point where we're going to have the bottom. And that will be a fantastic entry point for gold. But we'll need the Fed to step back in again. And they haven't done that yet, and they will not do it before they actually stare deflation right in the eye.
Can you take a minute to outline your thoughts on what's creating a deflationary environment? Because you're right, 5-6 months ago, there weren't very many people talking about that. Yourself and a couple others, and now a lot more people are. And so could you just outline that case for myself and my viewers? What are the major deflationary pressures that you're seeing right now, Henrik?
Sure, but that it's very easy. I mean, it's debt. It's debt.
It's debt.
We have so much debt around the world. Everybody is in debt. If you look at companies, if you look at countries around the world, and look at the US, it's just debt, and we know how that is on a private household. Also, if you owe a lot of money, you will not spend as much, because that it's putting a pressure on you. It's putting a pressure through the interest cost that you got on that debt. So that is what we see, and the more debt you have in the world, the more you will have deflationary pressures. And that's why we need to get past that. We need to get past that through restructuring, through debt forgiveness, through monetary reset. I'm also looking into that and seeing that coming at some point. So they'll do a lot of things, and we can compare that to what happened just after the Second World War, where we had the Bretton Woods. So we're gonna see a cleanup, a restructuring of all of this before we get to it, because this about adding more debt to fight the deflationary pressure is like, we have a saying in Danish which is peeing your pants to stay warm. It helps for like 20 seconds or so, and then it starts to get really cold again. And that's what we're seeing with QE, right? You add a lot of extra money into the system, and it kind of feels warm and fuzzy for a certain amount of time, and then it's not so warm and fuzzy anymore, because then it's just starting to hang on to you. And the way it does that is because when you lower interest rates, you get people to borrow more money. And that is why they think then that it's going to create a positive spiral and upturn like that. But the problem is that the big thing is debt, and it's becoming it's unmanageable on the biggest perspective. So that is why we see the deflationary pressures. That's why we're not going to see inflation in this environment. We see inflation because of mismatch between supply and demand, which I've said all along. I mean, the reason why we're seeing the current inflation spike is because they came out and they stimulated the economy with something which was 10 times the size of the Marshall Aid, which was the aid after the Second World War, where all of Europe was in ruins. And this time around, because of a supply crisis, which was stupidity. So you pump money into a system where it couldn't be, the demand couldn't be met. So of course you get inflation, and inflation is a lagging indicator, meaning that it comes, later in the business cycle. That's why also now that the business cycle has peaked, inflation is coming down, and that's why that's what we work on in our business cycle model. It has been obvious it's going to come down, and they will have to pull out an even bigger bazooka next time, and then we'll see how long it's going to be feeling warmer and fuzzy that time around.
Right. So simply put, debt eventually causes austerity. Austerity is deflationary. There's less money being spent, less money floating around. You could kick that can down the road with temporary stimulus programs that create spikes in inflation. Supply chain bottlenecks have amplified that. But these are, in your view, these are not the trend. These are just little distractions. Bumps along the way. Okay. Now, you mentioned two things. You mentioned possible debt forgiveness, and you mentioned possible monetary reset. I'd love to jump into both of those. Let's start with debt forgiveness. Where could that be applicable and foreseeable, and how could that play out?
But it's already playing out, and something, it doesn't happen overnight. But we have seen this about student forgiveness. Probably more about what's happening in the U.S. than I do. But we've seen the talks of that already. And this is the kind of path that we will see, that they will understand that in order to actually get the debt out of the world is that we actually take it away, and we then put it upon the Fed or somewhere, how they're going to do it. But they will, the debt forgiveness around the world, also for emerging markets and the likes, I think is going to be much more widespread, because it will be very, very obvious that you will not get real growth if you have a lot of debt in the world. And that the moment when that happens is the next step into, when I look at the long-term cycles, the contractive waves that you see actually get into the contractive spring, which can be compared to what we saw after the Second World War, when actually we had we had a lot of restructuring in terms of debt, and you had a lot of also on the monetary reset with Bretton Woods and the likes. And this was what caused the new growth into the 1950s. And we're going to see that again, but you already have these kind of talks coming up. But always, as always, we need a good crisis before they will get to that point. Is it fair? Is it something that people are going to like? No. Would it be necessary? Yes, it will be necessary for the bigger perspective of the economy, because otherwise you'll keep it, subdued. And then growth will simply not be able to pick up. The real growth rate will not be picking up. If you look at it, long-term growth rate has been declining over the last 30 years. And that's what they do. They need to get that up again. And the only way you can do that is to get real businesses out there, small businesses that can actually cope in a real environment where there are positive interest rates, and not needing to have this artificial environment. I know it's not like that right now, but in artificial environment with low interest rates, which is the only thing that keeps a lot of companies alive. So that is why debt forgiveness will be a part of that package, and that will be a fiscal move that we haven't seen, because the last time around in 2008, when we had the last recession, I'm jumping over nicely the corona crisis and the recession there, but that crisis was solved by monetary stimulus. This one needs to be, they will do it with fiscal, and that's why they'll also get to the point where inflation will start to pick up again, as I see it in the longer perspective, and we will have a secular bottom, as we had in early 80s. We had the top in the inflation. Now we will have the bottom in inflation. And over the next many years, you'll see an uptrend in inflation.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. And then how would you define a monetary reset, and what would you expect to see there?
But we're already seeing some of that because we see the BRICS countries now coming out and saying, "Oh, yeah, we're trying to put up a challenge to the U.S. Dollar hegemony," and you can understand why they want to do that. Of course, I mean the U.S. has a lot of power with that, so you can kind of understand why that is a desire from these countries, and there is a need for some kind of reorg of how the world is being run, because obviously it's not very from a long-term perspective, it's not very stable that you have just one country that can actually sit and then decide how the monetary system works. So I think that when we start to see inflation picking up, and this is now where we need to just slow down a bit here, because I think we got a deflationary period for now. But when we get into the next crisis and they step up one more time and they infuse a lot of money, they will get inflation, and they will actually get stagflation. And when stagflation comes out, that's the moment where something of different kind of tools needs to be taken out, which is a more of a structural perspective, setup that needs to be looked at. So sound money needs to get back in. You cannot have this that you just pump more money into the system and they blow up one bubble and then it collapses and then you do it the next time again. So there needs to be a sound system behind the sound monetary system. So what I'm seeing is that you've got external pressures from the likes of the BRICS, and you will get also pressure from other countries when you start to see inflation pick up, like what you had in the 60s when France was looking at at all the spending during the Vietnam War, and they said, "Hey, we want our gold back," and then they had to close off the gold convertibility. So you're gonna see this time around that something else is going to need to be constructed, and they have to be on top of it. And the Bitcoiners and the likes and the crypto people like to say, "Oh yeah, that's where Bitcoin comes in." I'm saying no, it's not going to be Bitcoin. It's going to be some kind of a structure set up from the driven from the politicians, from the central banks, and they will set something up which will create a new sound money system. But we need another crisis for that, because otherwise, and we need stagflation, we need inflation to move up again after the next step here, in order for them to start realizing that something bigger is needed.
Okay, and if you were to speculate about what that new sound money might be and how it might function, do you have any thoughts there? Is it some kind of a centralized digital currency backed by hard assets or commodities, a basket of commodities? Do you have any thoughts there, Henrik?
That would guessing, yes, thoughts and guessing, but it's something along those lines. Exactly. I mean, I think they will have to get back to say, okay, so gold has a central place in the monetary system and in the financial system, and I think it's going to be something about you show me yours and I'll show you mine, and then in terms of how much do we have, and then there will be some kind of basket there with a crypto element to it. Absolutely, something along those lines, and making it easier also and more transparent. And I think that's where the crypto people also may not like what I'm saying here, but I think it'll be more about transparency in terms of getting, sending money across the world, because that is what will trigger trade. It's not about the opposite, and that you can hide money or hide what your transactions. So the transparency about, a new system like that will then, and then that debt levels be coming down through forgiveness and restructuring and all that will be what is needed to get growth up and going again.
Okay, so a couple questions off of this. So this is a conversation that comes up on my show a lot, the monetary reset, new world reserve currency and all this. And it's often framed with this sense of urgency, like this is happening right now. You need to prepare right now. Can you give me your thoughts on a timeline? What's a more realistic transition period for a new world reserve currency to actually be introduced, stress tested, adopted, and utilized? I mean, it seems to me like a multi-decade process, not something that's going to happen in 2024. But what do you think, Henrik? What are your thoughts on this?
I think when it's needed, it will happen faster than what we think. But right now, when it's really needed, and I think we cannot, like, in September 21, I said, well, crypto is going to crash because the dollar is going to move up, and people they were laughing. And then now I'm saying, okay, now I'm long crypto because I think the crypto is going to go up, and people could laugh at that because sentiment really shifts really quick here. So we have to understand that when we sit right here and right now, we cannot look into a situation where deflation really takes hold, because we have had so high inflation over for some amount of time here. But when we see deflation starts to kick in, they will do everything to kickstart that, and they will get it this time around. Reason is because economy will be slow and moving, but the financial market will then see, oh, okay, they do this again, and then I think you will see a lot of commodities that will move a lot higher really quick. So that will create a stagflationary period, and that's the trigger for it, because stagflation is good for nobody. Stagflation will mean that bonds will lose value, stocks will lose value, and so on and so forth. So that will cause a lot of problem in the system, and I think we're going to see pension fund crisis and the likes. And you don't want to have that, because if you have that, then you'll have people in the streets with pitchforks and the likes. Yeah. So you got to stop that. And how do you stop it? You stop it by saying, okay, we need sound money. How do we do that? And then you'll have these crisis meetings. We know how things can happen rather quickly when the shit really hits the fan. And I think that is what needs to happen. So we need to see when stagflation sets in for real, and it's been starts to get embedded in the economy, then they will need to come up with something, because you can't print your way out of that. You can stimulate your way out of that. The only way is to create credibility to the system, and that I think will happen through something like that. But I think it's already in the cards. It's something that is being discussed without having any knowledge of that. I think it's something that they will and must be discussing at this point, also with the things coming up with the BRICS. And I don't think it's a coincidence that you start to see this with BRICS now, because that is the push also from China and Russia and elsewhere, who would love to see the US hegemony, the US dollar hegemony disappear.
Challenged, yeah, absolutely. Now, not knowing how this may shake out, do you think that's the incentive for the central bank gold buying that we saw increase so aggressively, especially in Q4 of 2022? I mean, if you don't know in 10 years what the reserve currency might be, but there's a possibility that's getting stronger, that it might be some kind of hard asset backed idea, it's in your best interest to stockpile that hard asset, or the most likely hard asset that would be utilized. So are those two things directly related, do you believe?
Perhaps. That would be guessing. That would be purely guessing from my side. I don't know what drives the central banks gold buying, and maybe there are some central bankers that are better at that than others. I think wasn't the Bank of England who sold all their gold, or a lot of their gold, just when gold took off in the early 2000s, early part of the 2000s. So I don't know what drives that, but yes, of course, it would be a good policy to start accumulating that. And I would also say that, of course, I mean, even though I think gold is going to go down, I also have physical gold, and will keep also increasing, my holdings of that, because it is something that will have when we talk in 10 years, it will be a completely different price. And I think that will be because we will see this the monetary reset, which probably will be around gold again. I mean, gold will shine again. I don't think the history of gold will disappear. Will it have a new digital element to it? Yes, I think it will.
Okay. Can you walk me through your portfolio as high level as you want to? How are you hedged right now? Where are you looking for safe haven status? Where are you looking for upside? As much as you want to share, talk to me about capital allocation.
Sure. So I have different funds that I invest, but I got a rather big portion of TLTs and bonds, and also German bonds, because I think they are steal at these prices and these levels here, because we're going to see a recession, and it's not inflation, and we now see that inflation is coming down, and that is as expected. But in the time frame from now and on to the recession starts, we're actually going to see what I think we also saw in 2008 or 19 into 2020 was that you both had bonds and equities going up a lot. And I think we are in an environment here, the Goldilocks zone, where we have, the inflation is not running too hot, it's not too cold. and we do not have a recession in the economy, I think we are in in for a blow off top in equities and risk assets. And so I have most recently, I have been buying, a lot of crypto, altcoins, Bitcoin, and the likes, and also small caps, because they are extremely undervalued at these levels here, as I see it, in the current environment. Will I hold them for 2 years? No, I would probably not. Some of these, cryptos and small caps, I'll be selling off in later this year. Some indicators that I'm looking out for in terms of when I think the business cycle is turning negative, or when we will see the recession set in, and also when I think that the stock top in the stock market will be. So I'm looking forward to looking into a strong period here of a blow off top, with S&P going to around 6,000, and we'll see new highs for a lot of cryptos, and I want to be part of that, obviously, but my defensive positions are being built as well, also at this point here.
Talk to me about those. How do you play?
Yeah, so that's mostly, as I said, bonds, TLTs, and the likes, and also and the likes, and I will be buying, so I'll be switching into dollars also at some point. I'm living in Denmark, Europe, Euro centric, and I will be shifting into as much as I can in US dollars when we start to see the beginning of the deflationary period, which I think will take hold in later this year. I think the DIX is going to 120, and that will be the part of the very devastating deflationary period.
Interesting. Okay.
And can I just say, not in a straight line, we're going to have we're going to see the DIX just first move to around 92 is my target, and then have that really steep rally into 120, which will be the deflationary, just to make sure people doesn't misunderstand that.
Yeah. Okay. All right. I appreciate that. Looking at small caps, any industries specifically, how do you direct capital? What are you looking at?
No, not really. Honestly, no, I don't. I don't spend much time on looking at industries there. I mean, there are a lot of, you can look at banks right now. Actually, I think there is a good move there coming in banks, but as in many other industries, you'll be looking at strong gains and growth stocks will be also something, because what I think we're going to see here really soon is that as liquidity has been starting to come back into the system. We've seen how the Fed has actually started, the balance sheet is now 60% up of the QT that they've done over the last year here, and it's it took them 2 weeks. And they will do more. And if you look at what the Bank of China has done, and also the same for the Bank of Japan, you've seen a similar kind of trend. So they are starting to infuse a lot of new liquidity here, and there is a lot of liquidity standing on the sidelines here. So when inflation comes out of the system, you're going to see a bounce, because the consumer then has a sigh of relief, because then pressure seems to be coming down. And then we will see a bounce in the economy. And that is what we're seeing right now. And I forecast that in October, November. It's taking a little longer to get started, but we are getting started there. And then we will see that risk asset will have its days for into at least let's say Q3, and then I think it's about getting out of that. So my allocation is broadly based on different industries, small caps for that short period of time, and then building a larger portfolio of TLTs, and then also obviously cryptos and the likes, which I think will experience the strongest FOMO that we have ever seen. Even though we have seen a lot, but I think we'll see even more.
And how do you qualify your decisions in the crypto space, specifically when it comes to altcoins? Do you look at utility on the infrastructure plays, or what are you looking at, Henrik?
Well, honestly, I think that when it comes to the real utility of things, I don't think I'll be a really good judge of evaluating which ones will be good for the long run. And I don't think that's what will drive up the price for the next 6 months here, or whatever, how long it's going to last. I think it will be more about FOMO, really. Just that's it's a big bubble that is going to be blown up here. The last blow in that bubble, and that is why you can I won't say you can be into everything, but of course there is we got the usual suspects, and we got crypto like Dogecoin, that which I also hold it a little bit. Do I trust it and do I believe that will be the future? Absolutely not. But there are others that I don't think, okay, this absolutely could have a future, but I don't know much about that. And that will not be the reason why I'm investing here. You could say I'm an early speculator. I would say that, if you invest, you do it because, you're like Warren Buffett. You went in and you say, okay, there is a mold around this company and they do well. Is that why I'm putting my money into crypto? No, it's not. Is it why I put it into certain cryptos? Maybe because I think in the long term, but I'll not keep them either way, because I think even the right ones will experience a large crash. Remember, we haven't seen a real recession while we have had crypto around. We haven't seen a 2007 into 2009, and I don't think it'll be nice on cryptos there. So I will not hold any cryptos during the deflationary bust.
Okay, very interesting. Look, Henrik, I can't thank you enough for the interview. Thanks so much for coming on and getting in front of my audience. Where can we push people if they want to hear and learn more about what you're up to?
So they can always go to my Twitter profile at Henrik Zeberg, and of course also to our website on the Zeberg Report, which is where we have a weekly show where I go through the macro situation, where we're going with markets, what is happening, and all that, and trying to make sense of it. And I do that on a multi market. I look into almost all markets around the world, and also multi-asset kind of perspective, and calibrate that, and then try to get a proper and sober view of things. Mm-hmm. And as many may know, I am not afraid of calling something rather which may seem outrageous, but that's what I do, and that's based on the structures that I look at.
Appreciate that. Okay, well, we'll include links to both. And
thank you
once again. Thanks for your time. I appreciate it.
Thanks for having me on.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.